What if I told you that reading one careful comparison of 4 companies could teach you more about investing than 100 headline-driven market stories? In this video, we'll do exactly that. We'll walk through Graham's side-by-side comparison of 4 listed companies, learn how to spot durable quality and hidden risk, and then convert those lessons into a simple, defensible stock selection framework for the conservative investor. Read closely, and you'll leave with a checklist you can use the next time you open a company report. Chapters 13 and 14 are the meat and potatoes portion of Graham's guide. Chapter 13 gives a concrete side-by-side comparison of 4 companies, showing how different corporate profiles translate into investment decisions. Chapter 14 then extracts the rules a defensive investor can apply, which stocks to include, which to avoid, and what guardrails to use. Together they turn abstract principles, margin of safety, diversification, quality checks, into usable actions. In this video, I'll translate Graham's examples into modern screening language and give you practical step-by-step rules for building a conservative stock list. Graham doesn't just preach abstractions. He rolls up his sleeves and compares real companies, the kind of work a careful investor should do. In Chapter 13, he picks 4 listed firms and walks through their balance sheets, earnings histories, dividend records, liabilities, and market prices, then asks, which should a conservative investor buy and why? That method, compare, quantify, then decide, is what separates analysis from guesswork. Graham's first filter is solvency. A defensive investor's job is to make sure a company can weather bad times. So ask, do current assets comfortably exceed current liabilities? How big is long-term debt relative to working capital? In his comparisons, the companies with current assets equal to or more than twice current liabilities and long-term debt, lower than working capital, looked structurally safer. Those balance sheet facts are not glamorous, but they're the bedrock of survival. Next, check earnings history and dividend continuity. Graham prized companies that showed steady earnings and consistent dividends over many years. A company with a long record of paying dividends and showing steady earnings is less likely to surprise you with a catastrophic collapse. In his comparison, the steady dividend-paying firms scored far higher on the defensive scale than the ones that reported volatile or one-off earnings. Even a strong company can be a bad investment if you pay too much. Graham checks price against conservative measures. Price to earnings based on multi-year earnings, price to book, and sometimes price relative to net current assets. The companies that looked safe also tended to be reasonably priced by these measures. The scary cases were firms with leverage problems and high price multiples. Those combine 2 failure modes: structural weakness and overpayment. Graham repeatedly emphasizes, the juicy facts are often in the footnotes. Guarantees, litigation, lease commitments, and pension obligations live there. In his 4-way comparison, companies with similar headline numbers revealed very different risk profiles once you examined contingencies. Don't skip the footnotes. They can turn a solid company into a risky one when obligations are counted. Numbers matter, but context does too. Graham looks at whether a company's earnings are driven by a stable, diversified business or by a narrow cyclical niche. A high-quality defensive candidate should have predictable demand or durable competitive advantages. In the chapter comparisons, companies exposed to cyclical commodity swings or fad-driven markets were automatically lower on the defensive list unless their balance sheets were exceptionally strong. Note Graham's approach. He leans quantitative for defensiveness, the protective approach, and uses qualitative judgment sparingly when they materially affect safety. That means a defensive investor makes the bulk of the decision from measurable standards and uses qualitative views only as a tiebreaker. This priority keeps emotion out of the core decision. Imagine Company A and Company B with similar market caps. Company A has current assets, Josh 2.5x current liabilities, low long-term debt, steady 10-year earnings, and dividends for 20-plus years. Company B has current assets, 0.9x current liabilities, rising long-term debt, and spotty earnings. Even if Company B trades at a lower PE, Graham would often prefer A for a defensive portfolio, because its balance sheet reduces the risk of a permanent capital loss. Price matters, but not at the cost of solvency. The takeaway from Chapter 13 is modest but powerful. Look at both the price you pay and the pattern of financial strength you buy. A cheap but fragile company is not the same as a cheap and solid company. Always combine price screens with balance sheet rules. Chapter 14 is a defensive investor's checklist. If you want steady results with low hassle, if you want to sleep at night, this chapter is your rulebook. Graham gives clear, testable standards for what the defensive investor should own and which candidates to exclude. I've distilled his rules into modern screening steps you can actually use. Graham advises defensive investors to stick with large, well-financed companies. Today, that often means blue chips or large-cap names. The firms with diversified revenue, easier access to credit, and public scrutiny. For many modern defensive investors, a total market index fund captures this automatically. But if you pick individual stocks, favor those with long operating histories and large market caps. A defensive stock should have shown earnings in each of the past 10 years, or a multi-year positive trend, and a stable dividend record. Graham's point is conservative, require evidence of consistent profitability rather than hope. Today, screening for positive earnings across several years and a consistent dividend payout filters out many risky businesses. Graham suggested practical valuation cutoffs to avoid overpaying. He recommended limits like moderate PE and a price-to-book not excessively above 1.5, his era's guidance. Translated for modern markets, where intangible assets lift book values, use blended checks. Look for reasonable PE based on 3 to 5-year averaged earnings, and be cautious if price-to-book is dramatically above sector norms. The goal: avoid paying for optimism. Keep leverage in check. Graham preferred companies where long-term debt did not exceed working capital, or where interest coverage was comfortably high. The defensive investor should avoid highly leveraged firms because leverage amplifies downside risk, particularly in recessions. Screening for conservative debt ratios is essential. Diversification is a defensive investor's best friend. Graham suggests broad lists rather than concentrated picks. If you're going to pick individual stocks, keep a large number, or even better, make a low-cost index fund the core, and use a small portion to tinker. The defensive investor's aim is not to beat the market by a lot. It's to keep risk low and returns reasonable. Here's a Graham-inspired defensive stock screen you can run quickly. Market cap, large cap, e.g. top 300 to 500 companies. Earnings, positive earnings in each of the past 5 to 10 years, or multi-year average positive. Dividends, consistent dividend payments for several years. Financial strength, current ratio, 2.0, or current assets, 2x current liabilities. Long-term debt, working capital. Valuation, PE, 3 to 5-year average, below sector median, or blended multiplier, PE x PB, below conservative threshold. Ownership, liquidity. Avoid stocks with extremely low float or low liquidity. Exclude highly cyclical commodity firms, speculative tech-only plays with no earnings, and companies with major off-balance sheet contingencies uncovered in footnotes. These rules are not designed to guarantee spectacular returns. They are designed to reduce the chance of permanent capital loss and to produce reliable, adequate returns over the long run. Graham's point: defensive investing is not glamorous, it's effective. It focuses on what you can measure and avoids what you can't, future miracles or management promises. Graham allows for modest preferences. If after applying the rules you still want to pick a small basket, do so only after the bulk of your portfolio meets these standards. He also notes that some industries inherently show lower book values because of intangibles. In those cases, be even more conservative on earnings stability and leverage. And always read footnotes for contingent liabilities. 4 practical items to act on after watching this video. Start with balance sheet safety. Require conservative current asset coverage and manageable long-term debt before considering price. Favor earnings and dividend consistency. Multi-year positive earnings and a dividend record are stronger evidence of durability than one-year spikes. Use conservative valuation screens. Price matters. Combine multi-year PE averages with price-to-book context to avoid overpaying. Make diversification your default. Let index funds be the foundation. If you pick individual stocks, keep the list broad and disciplined. Which of Graham's screening rules surprised you most? Balance sheet emphasis, the dividend focus, or the blended valuation checks? Drop a comment with one company you'd like me to run through the checklist. Anonymized tickers are fine, and I'll pick one for a full live walkthrough in an upcoming video. If you found this useful, hit like and subscribe for more breakdowns of classic investing wisdom. Next time we'll pick one company from your comments and run a line-by-line defensive analysis using the checklist in this video. Balance sheet, earnings history, footnotes, and valuation, so you can see Graham's method applied in practice. Say "analyze" in the comments if you want your pick considered.